Welcome back, options traders, and happy hump day to everyone. I hope everybody had a great extended Labor Day weekend. And so it's time to get back into some options topics. And for today, I've picked a topic that's a little bit more math than normal, but it definitely relates to options. Of course, options trading is art and science, so there's always going to be some math involved. But anyway, it's a very interesting topic, and I'll show you how there are some interesting relationships with options. And so the question is, how do fixed points relate to options? And of course, that means we have to figure out what a fixed point is first, and then I'll show you what it has to do with options trading. So let's go find out more about this. As always, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So fixed points is a really fascinating topic, sometimes with surprising results. And it really has to do with, depending again on a number of cases, where something doesn't move. Something is always going to stay fixed, no matter how you shuffle it, rearrange it, things like that. So an interesting application, kind of a fun one, imagine that we have a map of the United States. And I also have an identical map. And I'm going to wad that one up. This is on a piece of paper. It's the same size. I'm just going to wad this piece of paper up, and I'm going to place it somewhere on this map. And it doesn't really matter where we place it. It doesn't matter how we wadded up the paper. We're just going to place it somewhere on this map. And if we do that, there is at least one point, in other words, one city on the map underneath that will exactly line up with that same city in that wadded up piece of paper. Now, without getting into the details, if you really think about it for a moment, it should sort of make intuitive sense, but it is a surprising result. And again, it doesn't matter the size of this piece of paper or where you place it. There has to be at least one point that will exactly line up. Pretty strange. So how else do fixed points work? Well, again, it's more of a math concept, and it's basically a value that doesn't change under given transformations. In the previous example, we wadded up a piece of paper. That would be a type of transformation. But as a simpler example, let's look at repeated square roots of any number, and they will always equal 1. And that's because if you pick a number smaller than 1, it's going to get bigger until it hits 1. And what's the square root of 1? 1. And you're caught in a loop. It will just stay fixed at 1. And if you pick a number greater than 1, say 2, and keep hitting square roots, they will get smaller until you hit 1. So 1 is this fixed point. It's like everything is moving towards 1, and then it kind of gravitates there and just stays. And again, the reason for this loop is that the square root of 1 is 1. So that's why once you hit that number 1, you're just going to get stuck. So for example, let's bring up a calculator and try it. Let's pick 0.25, a number smaller than 1, and if we keep hitting square roots, they're going to get bigger. So watch, there's a half, and we go to 0.707, and these numbers are always getting bigger. Now, because of the number of decimals in this calculator, it's going to take a while, so I'm going to speed up through this. But you can see that eventually, there we go, getting closer, all nines, and then we hit 1. And every time I hit square root, I'm clicking it right now, it doesn't move. So 1 is a fixed point. Well, what if we made it larger than 1? Again, let's go to maybe 2. We hit square root. Now they're going to get smaller. 1.41 is smaller than 2. 1.18 is smaller. See how they're getting smaller as I continue to hit square root. So I'm going to speed up through this again, and you can see that we're getting closer to 1 until, boom, we hit 1, and now again, every time I click it, we're caught in a loop. So 1 is a fixed point of square roots. So again, what that shows is that no matter what point you pick, we could pick something like 0.25 that we looked at, maybe 0.4, maybe around 0.55. We come up here to maybe 1.25, 1.65 looks like, and maybe 2. And again, doesn't matter. They can be decimals, could be anything that you want. And as you continue to do repeated square roots, all of those points start to move towards 1. It's as if it's a magnet. They all gravitate towards there, and it just will not move. So this is more what we're going to see when it comes to options pricing, because as we've talked about many times, for the at-the-money options, there is a square root pricing relationship. And that's really what we want to explore here. What does this fixed point of 1 have to do with options? Well, let's go over to an Excel spreadsheet. So here's our Excel spreadsheet, and there's a couple of demonstrations here. Down below, this graph is just square roots. This is what we looked at, so I'm looking at 0, 0.05, 0.1, just counting by 0.05s. We're coming up all the way up to 2. So again, doesn't matter what number you pick. And if we graph those, the square roots of these numbers, which are in that column, we get this orange line. But this blue line is showing what if we have a linear relationship. We're just going in a straight line. So let's call it maybe dollar for dollar. Where does 0.1 line up with 0.1? That would line up on this straight line. And you can see that that straight line in blue crosses the square root function right there at 1. All right, so again, that's our fixed point. So keep that in mind as we go up to options pricing. So I told you there was something to do with options here, and so here we are. So what we're looking at here are option prices from a pricing model. We start with 0 days to expiration, then 30, 60, 90. We're just counting by 30 days. And over here, we're looking at the corresponding option prices. So these were shot with 20% volatility, no interest rates, and no dividends. So the 1-year option right here, 360 days, is priced at $7.91. And then what we're going to do in this column, what's called normalizing these prices, I'm just taking every price from this column and dividing by 791. So 0 divided by 791 is 0. We keep coming down. Obviously, 791 divided by itself is 100% or 1. And then we just keep going up the line. So we're just kind of putting all of these on the scale relative to 791. Next column shows the percent of the year. If we have 0 days to expiration, there's 0% of the year. 30 days is 1/12, or about 0.08 of the year. 1 year is 100% of a year. So now here's where things start to get interesting. If we look at the linear price, and what we're doing here is saying that if a 1-year option is $7.91 and everything was scaled according to this, so in other words, if we have a 30-day option, if options were priced in a linear fashion, which they're not, but if they were, this option here would cost 1/12 of this one. So we're just taking 30 divided by 360, or the percent of the year, multiplied by this price. So that option would trade for 66 cents. The 60-day option would trade for $1.32. So again, we're just saying that if options were scaled exactly according to this 1-year option, these would be the prices. But now watch this. If we graph the actual prices right there, square roots, and these are normalized, but it's a square root relationship. This is what we see in the real world of options. And then we compare it to the percent of the year, putting it on a standardized scale. That's the orange line, and we see that they cross at 360 days, or 1 year. And so this is our fixed point, is 1 year. So what this has to do with options is that the 1-year option is scaled exactly according to volatility. So in this example, we used 20% for the volatility, and this option would be priced at 20%. But now look what happens as we go to shorter dated options, something less than a year. You can see that the blue line, the real world pricing, sits above this linear pricing. You're paying a very big premium relative to the 1-year option for going shorter dated. And look at how high that blue line is compared to the orange. See, there's a very big premium in here. And if we go to this side of a year, something more than a year, we're paying less. The blue line sits below the orange. So we're getting a discount for going out in time. So again, this is just a different way of looking at what we've talked about before with this square root pricing relationship, that you have to go out, let's say, 4 times as much time to double an option's price. But what's interesting here is that it all hinges on this 1-year option, because that's where volatility is priced at itself. That's kind of our fixed point So if we look at the factor that you're paying, either the premium or the discount, that's right here. So what that is showing is that if options were priced in a linear fashion, we would expect it to trade for 66 cents. But in the real world, you're going to pay $2.29. So again, if they were priced according to our fixed point of a 1-year option, and this is only 1/12 of the year, they would be trading for 66 cents. But they're not. You have to pay $2.29. That is 3.47, almost 3.5 times more than if they were priced linearly. So that's 250% greater. So you can see that this premium is always greater than 1 until you hit the 1-year option. And again, that's just saying that the blue line is sitting above the orange. But once we go beyond a 1-year option, we start getting into discounts. We're paying, let's call that 96% of the linear price, or a 4% discount. So look what happens when you come way out here. Let's slide down a little bit to 1,080 days. That's a 3-year option. Look at this thing. You're paying 58%, or a 42% discount relative to a 1-year option. Now, where is this coming from? Well, again, we've talked about square root pricing. We could do square root of 3. We've got 3 times the amount of time relative to the 1-year option. So that price should be 1.73 times bigger than this price. So you can see that if I take 1.73 times our 1-year option, that becomes 1371. And that's almost what we got here. Now there's another subtle reason why we're not getting exact. I'm not going to go into that, but it's roughly at 1371, again, this square root pricing relationship. So once we have that, if I just take the reciprocal, if I take equals 1 divided by this, there's our discount. If we round it down there to 2 decimals, you'll see it's exactly 58. So again, it's just a different way of understanding this square root pricing relationship. And the thing that you want to understand is that with the 1-year option, if we have 20% volatility, we pay 20% volatility. But if you're going less than a year, effectively you're paying at a greater volatility. And if you go greater than a year, you're paying at less than that volatility. So it's just another super powerful way to show that all things being equal, if you're just buying an option just because you think it's going higher and you just want to hold, whatever, Microsoft for a long time, it really pays to go long term. And I still hear so many traders that want to keep trading 30-day options over and over, and they say, well, that way if I lose, I've really minimized the loss. And the answer is you probably haven't. You've probably magnified it because of this extreme premium that you're paying for these shorter dated options. Now, of course, there's always exceptions if you're trying to play gamma or other characteristics of an option. Sure, you're probably going to want to use shorter dated options and at the money. But the main thing here is I get a lot of emails and conversations with traders who say, I just want to hold this stock. I just think it's going up over time. You don't really have a planned exit date. And if that's true and you just want to take this long-term upward bias, this should be a really powerful demonstration why it will pay to buy your longer dated options. And the reason for this relationship is our fixed point of 1 year. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.